Hello, everyone. Let's start our today's discussion. I hope you all remember that in the previous class, we started basic income tax calculation. In the basic income tax calculation, we discussed that how a basic tax return looks like. We discussed that in UK, the incomes are divided in three heads: non-saving, saving, and dividend. All three heads of income have different tax rates. We discussed that we add all of the incomes, we deduct the personal allowance to arrive at the value of taxable income. And then we looked at the tax bands. I hope you all remember. Then we discussed two basic practice questions on the tax return. We discussed that how we have to work the tax bands. Okay. And then we discussed real estate investment trust. It's a mutual fund which raises funds from the public and then invests those funds in the property market. And we discussed two practice questions on that matter, that how we deal with withholding tax and how it is adjusted in the final tax liability. Today we are moving forward and we are discussing one more concept, which is dividend income. What we will be doing is that we will be adding the concepts and we will continue doing the practice questions so that things remain clear in your mind. Okay? Now, what is dividend income? Dividend income means the profit distributed by a company. If we own share of a company, the profit distribution which we get is called dividend income. Now, if you remember, in the tax return, the dividend income is shown as a separate head of income. One was non-saving, one was saving, and the third one was dividend income. Dividend income means profit distribution done by the company. So if we are getting dividend income, how it is taxed? First of all, you need to understand that there is no withholding tax. There is no advance tax on dividend income. You will receive the entire amount. The rates of tax for dividend income are basic rate band. In non-saving, the rate of tax is 20, whereas in dividend, the rate of tax is 7.5%. In higher rate band, it was 40% in non-saving. In dividend, it is 32.5%. And above 150,000, which is additional rate band, in non-saving it was 45%, but in dividend it will be 38.1%. These are same bands. They are first used by non-saving income, and if any band is remaining, that is used in dividend income. How it works, we will look at in the practice question. First, 2,000 pounds of dividend income are taxed at 0%. Now, irrespective of whatever tax bands you lie in, first 2,000 pounds of the dividend income are always taxed at 0% band. Now, how does it work through? Let's look at a practice question. We'll come back, we'll revise, we'll do the practice question until the things will get clear in your mind. Let's look at it. Practice question number 5. Mr. Z has following incomes for the year. Trading income 39,000, employment income 4,000, and dividend income is 10,000. Now there will be two heads of income. The first one is non-saving, and the second one is dividend. Trading income goes in head of non-saving income, 39,000. Employment income goes in head of non-saving, 4,000. And dividend income goes in head of dividend, 10,000. First of all, we need to classify the income in right heads. Mr. Z has following incomes for the year: trading income, employment income, and dividend income. Once we have classified the incomes, we will arrive at the value of total income. 39 plus 4 is 43, and here it is 10,000. We will deduct personal allowance. The personal allowance is first deducted from non-saving income because its tax rates are higher. We need to offset that income first, which have higher tax rates. Non-saving income has rates of 20, 40, and 45, whereas dividend has 7.5, 32.5, and 38.1. For tax rates, you don't need to worry. They will be given in the exam paper. A separate tax rate sheet is given. So don't worry about it. Now, once we deduct the personal allowance, we will get the value of taxable income. What is the taxable income? 43,000 minus 12570. So this is 30,430, and this is 10,000. Now we have to apply tax on it. Non-saving income is 30,430. Up till 37,700, the rate of tax is 20%. Up till 37,700, the rate of tax is 20%. This entire income of 30,430 lies in the first band. The first tax band is still 37,700. This entire income lies in the first band. Now, the dividend income is 10,000. The first 2,000 pounds of dividend income are always taxed at 0%. The first 2,000 pounds of dividend income are taxed at 0%, irrespective of whatever band you are in. Now in the basic rate band, the basic rate band is still 37,700. How much amount is remaining? How much amount is remaining? 37,700 minus 30,430 minus 2,000. 5,270 is remaining. In basic rate band, the dividend income is taxed at 7.5%. So this gives us 395. I will repeat it again. Non-saving income, 30,430. Non-saving income, 30,430. In basic rate band, it's 20%. Dividend income, up till 2,000, it's 0%. Then, look at the basic rate band. The amount remaining in basic rate band, 7.5%, and the remaining dividend income. Now, what is the remaining dividend income? 10,000 minus 2,000 taxed at 0%, minus 5,270 taxed in basic rate band. So 2,730 dividend in higher rate band is taxed at 32.5%. So it is 887. I will repeat it again. So listen to me carefully. 6086, 395, and 887. This gives me tax of 7368. Look at it again. The first thing which we have to do is we have to put the incomes in the right heads. Non-saving income 39 and 4, Dividend income goes in head of dividend. We add up all of the incomes to arrive at total income. Then we deduct the personal allowance to arrive at taxable income. Now we have to apply the tax. 30430 goes in basic rate band straight away. 30430 goes in basic rate band straight away. Because the basic rate band is still 37,700. Now the dividend income of 10,000. The first 2,000 goes in 0% band. Then the amount till the basic rate band taxed at 7.5%. The remaining dividend goes in higher rate band. So, when we talk about dividend income, so how the dividend income works? When we talk about dividend income, dividend is the amount of the profit distributed by the company. Dividend is the amount of profit distributed by the company. There is no withholding tax. There is no advance tax on dividend income. What are the rates of tax? Basic rate band till 37,700. Then higher rate band till 150,000, and then additional rate band. The tax bands are first used in non-saving income, and then they are used in dividend income. Because the non-saving income have higher tax rates, so we give the bands first to them. Otherwise, they will get taxed at a very high rate. We classified the incomes, we deduct the allowances, we arrived at the value of taxable income. Now the entire non-saving income lied in the first band. So 20%, then the first 2,000 of dividend income is always taxed at 0%. The amount remaining in the band taxed at 7.5%, and remaining goes at higher rate. I hope that this is clear. Okay. Let's look at one more practice question. Always remember that practice is important. When you do the practice questions, the concept will get clear. Let's look at it. Mr. Z has following income for the year. Trading income 27,000, dividend income 20,000, REIT, real estate investment plus 5,000. On REIT, there is withholding tax of 20%, and since the examiner is silent, so it is net. Now, one head of income is non-saving, and the other head of income is dividend. Okay, now, trading income. 27,000 goes as it is in non-saving. Dividend income 20,000 goes in head of dividend, and then there is REIT. On REIT, there is 20% withholding. We discussed it in the previous class. So we will gross it up, and REIT dividend goes as a non-saving income. It is not a dividend income. This goes as a non-saving income because it is real estate income. It is property market income. So 5,000 divided by 80% into 100%, we will gross it up. Okay? Now, If we add all of the incomes, we will arrive at the total income. 27,000 plus 6250 is 33,250, and here it is 20,000. We will deduct personal allowance from it. The personal allowance is 12570. This gives us the taxable income of how much? 20,680, and here it will be 20,000. Let's apply tax on it. Non-saving income lies in basic rate band. Non-saving income lies in basic rate band because basic rate band is still 37,700. Then we have dividend income, 20,000. On first 2,000, it is 0%. So it gives 0. Okay. Now, let's look at the basic rate band, that how much amount is remaining. Okay. How much is remaining? 20,680 plus 2,000 minus 37,700. So 15,020 goes in basic rate band. It will be taxed at 7.5%, 1127. And then finally, how much dividend is remaining? 20,000, 2,000 taxed at 0%, 15020 goes in the basic rate band. The remaining 2980 goes in higher rate band at 32.5%, which means 969. Now, this all is clerical work. There is nothing difficult in it. Tax liability, 4136, 1127, 969. So this gives tax liability of 6232. We will deduct advance tax, the tax credit from it, to arrive at the value of tax payable. Now, what was the advance tax? Which we grossed up on the real estate investment trust. It was 1250. So the payable will be 4982. So I'll give a brief review again. If you will look at it, you will be able to understand in a better manner. When we talk about dividend income, it is profit distribution from the company. When we talk about dividend income, it is profit distribution from the company. There is no withholding tax on dividend income. Okay, you receive the entire amount. Okay, you receive the entire amount. There is no withholding tax. There is no advance tax on the dividend income. Okay, now for dividend income, you need to understand that there are separate rates of tax. There are separate rates of tax. Unlike non-saving income, it will be taxed on a separate bands. Okay, now the basic rate band 37,700, non-saving has a rate of 20%. The dividend has a separate rate of 7.5%. Then here the rate was 40%. In this case, it will be 32.5. Here it was 45. Here it will be 38.1. Okay, first 2,000 pounds of dividend are taxed at 0%. So dividend income is taxed as a separate head and it has its own rates of tax, different from non-saving. But the tax bands are same tax bands, first used in non-saving and then used in dividend. We classified the incomes. Same routine work, first 2,000 at 0%. Then we looked that, okay, how much amount is remaining in the first band? And then the remaining. In this question, same thing. There was REIT, so there was withholding tax on REIT, which we discussed in the previous class, that on REIT there is 20% withhold. Then we grossed up the REIT income, we classified the incomes, personal allowance, non-saving income goes in the basic rate band because the band is still 37,700. The first 2,000 of the dividend goes at 0%. Now we looked at the remaining band. 20680 plus 2,000 minus 37,700. The remaining band, the dividend rate is 7.5%. And then rest of the dividend income taxed in higher rate. I hope that you people are understanding it. Is it clear? Let's look at one more practice question before we move forward. The purpose of doing these practice questions is to give you people more and more clarity. You people can understand that how the things go. Okay, let's look at it. Okay, so Mr. Z has following incomes for the year. Employment income is 12,000. Dividend income is 7,000. REIT dividend is 4,000. We have to calculate the tax payable. Again, one head of income is non-saving and the other one is dividend. Employment income is 12,000. Then we have dividend income. Dividend income goes in head of dividend. And then we have REIT. On REIT, 20% tax is withholded. So we will gross it up. Withholding tax is 20% and we receive net amount when the examiner is silent. So divided by 80%, multiplied by 100%. So the gross amount I think will be 5,000. Yes. So employment income goes in non-saving. Dividend goes in head of dividend. REIT, withholding tax is 20. Since the examiner is silent, so it is net amount. Now, the total income is 12 plus 5, 17,000. And here it is 7,000. The personal allowance is 12,570. This gives us the taxable income. What is the taxable income? 17,000 minus 12,570. So it's 4,430 and it's 7,000. Now we'll apply tax on it. Non-saving income, 4,430. Basic rate band, 20% tax. So it's 886. And then we have dividend income, 7,000. On the first 2,000, it will be 0%. So it will be 0. And obviously, the basic rate band continues till 37,700. So the entire dividend will come in the basic rate band. The remaining 5,000 goes at 7.5. So it's 375. The tax liability will be 375 plus 886. So it will be 1261. We will deduct the advance tax, which was paid on read, to arrive at the value of remaining tax payable. Okay, so the advance tax was 1,000. The remaining payable is 261. I want you all to concentrate on it. So what we have discussed, we said that, okay, the employment income goes in non-saving. The dividend goes in the head of dividend income. For the real estate investment trust, we grossed it up. Divided by 80% into 100%. 12 plus 5, this gives total income. Dividend goes in head of dividend. Personal allowance, taxable income, and the simple tax calculation. So till now, what we have discussed? We have discussed how to make a tax return. In the tax return, there are 3 heads of income: non-saving, saving, and dividend. There are 3 heads of income: non-saving, saving, and dividend. These 3 heads of income have different tax rates. Non-saving income includes all the incomes. It is normally called as a normal head of income, which includes all the incomes except interest and dividend. They are classified separately because they have their own tax rates. Okay, we discussed the personal allowance. We discussed the tax bands. Then we looked at the real estate investment trust. It's a mutual fund which raises fund from the public and then invest in the property market, invest in the real estate market. Okay, are you getting it? And then we discussed about the dividend income, the profit distributions received, the tax rates of the dividend income, the 0% band in the dividend income. Okay, I hope that things are pretty much clear till here. Okay, now let's move forward. Another concept which we are starting is trust income. Now this concept has a theoretical concept a bit. So let's look at the theoretical concept and then we'll move towards the calculation element. Listen to me, things will get clear. Now, when we talk about trust income, first of all, what you need to understand is that what a trust is. What is a trust? So you need to understand that trust is a body. It is an artificial body. It is like a company. It is a body which is created in which the donor donates the assets. Those assets are managed by the trustees, and the benefit of the trust is given to the beneficiaries. I will repeat it again. Trust is a body which is created by a donor. He gives the assets. Those assets are managed by the trustees, and the benefit is given to the beneficiaries. Now you must be thinking that why people create trust. So trusts are created for multiple reasons. Like for example, if someone is dying, his death is near, and he has a very big business. He feels that beneficiaries will not be able to manage that business, so he will create a trust. He will give the assets to the trust. He will appoint the trustees, and he will ask the trustees to give the income to the beneficiaries. Now, the beneficiaries can be small children, or it can be some NGO or whatever. So trust is a body in which a donor donates the assets which are managed by trustees, and the benefit is given to beneficiaries. Now, why is the trust created? So there are following reasons. To give income to those who cannot manage it. Like, for example, small children, some NGO, anybody which cannot manage it. So you want to give income to those who cannot manage it. So by creating a trust, we ask the trustees to manage that income. A trustee, a group of people is appointed to manage it and to give income to the desired people. Like, for example, if a person is dying and he wants to give the income to his small children, so he will make a trust. He will ask the trustees to give income to his small children. Or maybe you want to give income to beneficiaries in a systematic manner. Like, for example, if he thinks that beneficiaries will not use the income in a systematic manner, so he can make a trust and ask the trustees to give them certain amount every month. So what is trust? It is a body created by a donor. Donor gives assets in the trust. Those assets are managed by the trustees for the benefit of beneficiaries. Trustees will get a salary. They will get a remuneration. They are like board of directors. Donor is the one who is giving the assets, and beneficiary are the people who will get the benefit of the trust. Now, the trust can be created because the beneficiaries cannot manage the trust, or the donor wants the income to be given in a systematic manner, or sometimes the trust is created for income tax planning. Like, sometimes what happens is that the donor himself becomes a trustee. So the question is that if he himself is the trustee, why did he create a trust? So he created a trust so that he can distribute the income on names of multiple beneficiaries from his own family. By doing this, he will be able to use their personal allowances and basic rate bands. To do income tax planning by making the trust, donor himself becomes the trustee, and then he extracts income on name of multiple beneficiaries so that their basic rate bands and personal allowances are used. Now, what does it mean by this? Like, for example, I create a trust, I give my whole business to that trust. Now, what I will do is that I am the donor, I am the trustee. Now, rather than taking the entire income on my own name, I will also become the beneficiary. What I will do is that I will make multiple family members as a beneficiary. And I will take out income on their names so that their personal allowances and basic rate bands are also utilized so that we have to pay lesser tax. So what is a trust? Trust is a body. Trust is a separate body. It is an independent body in which the donor gives the assets. Those assets are managed by the trustees for the benefit of beneficiaries. Now the question is that why a trust is created? What is the reason? Why someone creates a trust? So maybe he wants to give income to those who cannot manage it, like small children. Or he wants the income to be distributed in a systematic manner. Or maybe he wants to do income tax planning. Now, what do you mean by this, that he wants to do income tax planning? What do you mean by this? So the concept is that by making a trust, what a donor can do, that he himself becomes the trustee. And then the income of the business which he was doing, he will not take it on his own name. Rather, he will distribute it among different family members so that he can use their basic rate bands and personal allowances. Now, this is permitted tax planning, that you can create a trust and you can do this. And there is inheritance tax planning also involved in it. Now, we will discuss inheritance tax concept in IST. What people used to do is that if you will keep the assets on your own name, you have to pay 40% inheritance tax on your death. So what people do is that they give assets to a trust. Now, while giving assets to a trust, yes, the inheritance tax is payable at that time also. But the major benefit which you get is that on subsequent deaths, that when you will die or when subsequent people in your family will die, there will be no IST payable on every death. Like, for example, if the business is on my name and I die, there will be IST. If a property is on my name, I die, there will be IST. Then that property passes on to my family member. When he dies, there is again IST. And then subsequent family member dies, again IST. On every death, there is inheritance tax payable. But when we give an asset to a trust and we make our family members as a trustee who can decide the beneficiaries, the benefit is that on every death, there will be no inheritance tax because the assets were not owned by any individual. They were owned by a trust. If asset is on name of individual, then IST is payable at 40% on death. However, if assets is kept on name of trust, then IST on each death will be saved. On the first time, yes, the IST will be payable when the asset is gifted to trust. You will study it in inheritance tax. But later inheritance taxes, which would have been payable on every death, they would get saved. So what I'm trying to say is that what is a trust? The first question is that what is a trust? The first question is that what is a trust? So the answer is that trust is an independent body. Trust is a separate body which is created by the donor. The donor gives the assets in the trust. Those assets are managed by the trustees for the benefit. The benefit is given to the beneficiaries. Now, why is the trust created? What is the reason behind it? Why do we create a trust? The first reason, to give income to those who cannot manage it. The first reason is to give income to those who cannot manage it. Like small children, to distribute the income in a systematic manner. Now, these are the legitimate reasons. Like, for example, a person is dying and he wants the income to be distributed in a specific manner, or he wants the income to be given to those who cannot manage it themselves, those who cannot manage that entire business empire. So he created a trust, he appointed the board of trustees, and he asked the trustees to give income in a specific manner. But other reasons can be to do income tax planning. What people started doing, and it is permitted, this is acceptable tax planning, that people make a trust, they become the donor, they become the trustee, and then when the trust earns, they don't take the entire income on their own name. Rather, they distribute the trust income on the name of multiple beneficiaries so that their basic rate bands and allowances are also used. Other reason is to do inheritance tax planning. Now, what do you mean by inheritance tax planning? If the assets are on name of individuals when they die and when their successor dies, and when their successor dies, on every death, 40% inheritance tax gets payable. But if we create a trust, if we make a trust, the assets are not on the name of individuals. While first time gifting to the trust, there will be inheritance tax, but then the inheritance tax on subsequent deaths will get saved. Okay, so for these reasons, the trusts are created. Now, there are two types of trust which are created. The first one is called discretionary trust. The first one is called the discretionary trust, and the second one is called interest in possession trust. Now, what is discretionary trust? Discretionary trust is a trust which operates according to the discretion. Word discretion means choice, will. Discretionary trust operates according to the discretion of the trustees. The trustees have full power in this trust. Donor gave the assets. He appointed the trustees. Now trustees will have full power in the trust. They can do anything. Now, normally when a discretionary trust is created, the donor himself becomes the trustee. So obviously this is not a situation when he is dying. The donor himself becomes the trustee. Now you must be thinking that why he creates a discretionary trust. He gives the assets to the trust, he becomes the donor, and he himself becomes the trustee also. He himself becomes the trustee also. Now he uses the trust to do income tax planning. He distributes the income on multiple names. He can save the inheritance tax. This trust operates according to the discretion of the trustees. Trustees have full power in the trust and they can take all the decisions, such as decision to close trust, decision to change beneficiary, or decision to change the business activity. In discretionary trust, donor himself becomes the trustee. Obviously, you will not give all the powers to the trustee. You yourself become the trustee. The basic objective of creation discretionary trust is to do tax planning. The beneficiary has no rights because the trustee can change the beneficiaries. Beneficiaries have no defined rights because the trustees can change their rights. If the trust will give any income to the beneficiary, it will be taxed on receipt basis. Receipt means that in the year in which you will receive, in the fiscal year in which you will receive, you will be taxed. You don't have defined rights, so there will be no accrual basis. Accrual basis means that even if it is not received, your right is accrued, so you have to pay the tax. Here you don't have any right. You don't know that what amount you will receive this year because all the powers are with the trustee. He will do the tax planning. He will think in his own beneficial way. In discretionary trust, beneficiaries will be taxed on receipt basis. Income will be taxed under non-saving income head, and the withholding tax, which means the advance tax, in this case will be 45%. Now, very high advance tax is taken because people use this trust to do tax planning. So the tax department says that at least we should take advance tax so that we can use the funds for some time. So listen to me carefully. What is a trust? What is a trust? So we said that trust is a body in which the donor donates the assets. The donor gives the assets. Those assets are managed by the trustees. The donor gives the assets. Those assets are managed by the trustees for the benefit of beneficiary. Now, why the trust is created? To give income to those who cannot manage it, or to give income in a systematic manner, or to do income tax planning. There are multiple reasons. Like by creating trust, what we do is we distribute the income on name of multiple people. Now, this all is done in discretionary trust because the donor himself becomes the trustee. The donor himself becomes the trustee. He uses the trust to do tax planning. Discretionary trust. The trust operates according to the discretion of the trustees. The trust operates according to the discretion, the choice of the trustees. Withholding tax is 45%. Income is taxed under the head of non-saving. The other type of trust is called interest in possession trust. Now, what is interest in possession trust? Now, in this trust, trustees are just an employee. In interest in possession trust, the trustees are just an employee of the trust. In this type of trust, trustees are just an employee. Trustees will have to follow the instructions of the donor given in the constitution or in his will. Now, interest in possession trust is created when your children are small or when you want to go for systematic manner. Because here the trustees are just an employee and the donor's instructions are followed. Beneficiaries have defined rights in interest in possession trust. The trustees cannot change their rights. In discretionary trust, the trustees can change anything. In discretionary trust, the trustees can change anything. But in interest in possession trust, they cannot change it. The rights are defined. Primary reason of creating IIP is to give income to those who cannot manage it. Now, what was discretionary trust? It operated according to the discretion of trustees. The trustees used to change the things. The trustees used to change the things to do tax planning. But in interest in possession, this cannot be done. The trustees have to follow the instructions of the donor given in the constitution of the trust or in the will of the donor. Beneficiaries have defined rights. Beneficiaries have defined rights. The donor defines their rights which have to be followed. Primary reason of creating IIP is to give income to those who cannot manage it. Income from IIP is taxed on beneficiaries on accrual basis. Because here you have defined rights. So even if you haven't received your income share this year, it will be taxed because you will receive. Your right have get accrued. Okay? Income from IIP is taxed as non-saving income for beneficiary if the trust earns from non-saving or saving sources. The withholding tax will be 20%. If the trust has non-saving or saving sources. What do you mean by this? Like if the trust earns from trading activity or if the trust earns from property activity, if the trust earns from non-saving or saving sources, the beneficiary will also be taxed as a non-saving income. The withholding tax will be 20%. If the trust earns from dividend income, like if the trust has company shares and the trust earns from dividend income, then for beneficiary also it will be dividend income, and now withholding tax will be 7.5%. These calculation bits will get cleared in the practice question, so don't worry about it. So what is the concept of trust income? If you look at it carefully, trust is a body. Trust is a body in which the donor, trust is the body in which the donor gives the assets to the trust. Those assets are managed by the trustees. Donor gives the assets to the trust. Those assets are managed by the trustees for the benefit of beneficiary. This means that the income goes to the beneficiaries. Okay? Now the question is that why trust is created? Why do people create trust? So they want to give income to their small children. So they create a trust because their small children cannot manage the entire business themselves. So they create a trust. Okay? Or they want the income to be distributed in a certain systematic manner. They want the income to be distributed in a certain systematic manner. So they create a trust. Or they intend to do some income tax planning. Like by creating trust, what they can do is that they can distribute the income among multiple beneficiaries. They can get the benefit of basic rate bands and personal allowances. Or they want to do some inheritance tax planning. So these are the reasons why people create trust. Now, there are two types of trust. One is discretionary trust. The discretionary trust operates according to the discretion, the choice, discretion of the trustees. Normally, the donor himself. Normally, the donor himself becomes the trustee. No one will give his entire business to the control of someone else. The donor himself becomes the trustee. And he uses the trust to do income tax planning. He changes the beneficiaries, he changes the amounts. He uses the trust to do income tax planning. Beneficiaries have no defined rights because the trustee can change anything. Withholding tax is 45%, the advanced tax. The income will be taxed under head of non-saving. Then when we talk about interest in possession, the beneficiaries have the defined rights. Those rights are defined by the donor. Those rights are defined by the donor in the constitution or in his will. The trustees are just an employee. They just have to follow the will. They just have to follow the constitution. Now the beneficiaries have the defined rights. They will be taxed on accrual basis. If the trust earns from non-saving or saving sources, this is the default category. If the examiner is silent, we assume that the trust earns from non-saving or saving sources. The income will be taxed as non-saving for the beneficiary. Withholding tax will be 20%. If the trust earns from dividend income, then withholding tax will be 7.5% and the income will be taxed under head of dividend. So what we have discussed in this chapter till now is, we discussed the basic income tax return. We did 2 practice questions. We discussed what a real estate investment trust is. Then we discussed that what dividend income is. And we have started our discussion on trust income. Now, when we look at the practice questions of the trust income, you people will get clarity that how the trust income works. Okay, but today's discussion, I'm stopping it here. I want you all to revise this theory. In the next class, I will give you a brief review of this theory again, and then we'll do 4 practice questions on trust. Okay, my approach is very simple. You all know that first I teach the concept, then we go through the practice questions so that we can get clarity. Okay, thank you, everyone.